Welcome to The Rubber Meets the Road Economics, the podcast where we explore the driving forces behind today's economy and their real-world implications. Join investor Hunter Craig as he interviews Professor Edwin Burton from the University of Virginia, delving into the complexities of economics with clarity and insight. Whether you're an economics enthusiast or just curious about how economic policies affect your daily life, you're in the right place. Let's get started.
Today is September 4th, 2024. Professor, welcome.
Hello, Hunter Craig. How are you this wonderful morning?
Couldn't be a better day. Professor, several people have asked about your educational background. Could you speak? Where did you get your PhD?
My PhD is from Northwestern University, which is up in Evanston, Illinois, just north of Chicago on Lake Michigan. Beautiful place, wonderful department. I had actually 2 years there, not 4 years, because I spent 2 years at Northwestern and 2 years at University of Chicago. But my thesis committee was from Northwestern, and my PhD was awarded from Northwestern, although I studied under a University of Chicago mathematician of all things, Hirofumi Uzawa, who was probably the most famous mathematical economist in the world at the time. I was lucky to study under him. So that's where my PhD is from. I was an undergrad at Rice in Houston, Texas, where I grew up.
Did you study under Milton Friedman?
I went to all his seminars, but I didn't study under him. That wasn't my field. Friedman was such a dominant figure at the University of Chicago. This was in the 1960s. I first arrived at University of Chicago in 1966 and was there for the next 2 or 3 years. Was lucky enough to spend a lot of time with not only Milton Friedman, but George Stigler was there, and a lot of very famous Chicago people were there at the time. I did not study under those people, though. I studied under Uzawa. I was a mathematical economist with little or no interest in the things that later I became somewhat interested in. Then Friedman came to Cornell. When I was a professor at Cornell, Friedman came and gave a brilliant talk, and we had a huge turnout of students. I also used to watch Friedman debate the people that didn't agree with him. I remember going up to Lake Forest College and watching Friedman debate Paul Samuelson of MIT on the question of what the role of money is in the economy, which is a pretty interesting topic these days. So Friedman had a big influence on me, but I really never took a class from him or anything else, but I went to a lot of seminars where he was speaking.
You taught Seth Klarman, the legendary hedge fund manager at Cornell, and he has stated that you were its most impactful professor. Has he spoken to your class at the University of Virginia?
He's done a lot of cameos. I don't really remember knowing Seth Klarman at Cornell because he was in a class where there were 500 students, of all things. And it just happened one day, one of my undergraduate students from the University of Virginia was at Wharton getting an MBA, and she sent me an email that Seth Klarman had given me a shout-out at Wharton. And, of course, I emailed her back, who is Seth Klarman? And that became a long series of back and forth. And eventually, Seth and I connected, and he came in and did a number of cameos during that summer. And I hope to get Seth to come up to the University of Virginia and spend a full day with us, and he's agreed to do that, but we haven't set a particular time. But he still calls me Professor Burton, which is kind of interesting to have someone. It's like Warren Buffett calling you Professor Burton. That still happens with a lot of my students. And when Seth was my student, I wasn't a lot older than he was. When I joined the faculty at Cornell as an assistant professor, PhD in hand, I was 26 years old.
And then when did you go to Smith Barney?
I was 32 when I went to Smith Barney.
And you ran the options department at Smith Barney?
Yeah, most of the derivative business and some other areas. I ran part of the block trading area, too.
A legendary story. Can you repeat that story about the gentleman who calls in and you tell him to hold, yell across the room, tell him to hold?
Bruce. I won't reveal where Bruce worked, but he was a very senior guy at a pretty well-known public company. And Bruce and I talked a lot informally, but I didn't know which stocks were likely to go up or down, nor did I believe I knew that. But Bruce was always asking me, and I would just kind of avoid the question. But anyway, one day I was on the desk, and somebody yelled, "Bruce is on line 7 for you." And so I yelled back, "Have him hold." And then I forgot all about it, and the market closed. And about 4:30 that afternoon, after the market closed, Bruce called me up, and he said, "Boy, I always make money when I talk to you, Eddie." I was known as Eddie on the trading desk. And I said, "What do you mean, Bruce? You and I never talked today." He said, "What are you talking about? You told me to hold on to my national semiconductor options. And after the market closed, national semiconductor was up 40 points. I made a fortune in these options. And they were worthless at the time I called you." So for the next month or so, Bruce believed in that great dream. But the truth is, I had no idea why Bruce was calling or what happened that day. But the legend arose that I could predict individual stocks, which of course was not true. It took Bruce a while after that to learn the sad truth.
Today is September 4th. Investors no longer have the euphoric mood that they've had for several years. Federal Reserve meets September 17th and 18th. There's been some indication from Chairman Powell that they're going to reduce interest rates 25 basis points. Could they do 50 basis points? You've spoken in the past about how the yield on the 1 month, 2 month, and 3 month U.S. Treasury really dictates what the Fed can do. Can they make a 50 basis point cut if they wanted to?
Well, for arbitrage reasons, they really can't, and it'd take us pretty far afield to explain it. But keep an eye on the 1 month, 2 month, and 3 month Treasury bills. Whatever the Fed will do, they'll put those bills inside their target range. And right now, those bills are trading at 510, 518, 522. That puts them all inside the 5 to 5.25 range. So that tells you they're going to move it to 5.25. But today is not September 18th. So between now and then, the T-bill market could change. Yields could go higher, they could go lower. Probably they'll go lower. The question is, do they go low enough to tempt the Federal Reserve into moving that target range down to 4.75 to 5? I doubt that will happen. Now, they can't just lower it to 4.75 to 5 if the yields are above 5. And if you think about it a minute, you'll realize there's an obvious arbitrage that Wall Street firms can make a mint from doing by simply buying something at 5.25 and financing it at under 5. And that works. The only risk of that is the Federal Reserve says, "Oops, we made a mistake yesterday lowering the target range. We're going to put it back up," which they're not going to do. So keep an eye on the 1 month, 2 month, 3 month T-bill yields. They're the best predictor of what the Fed's going to do. At the moment, they're showing the Fed to do 25 basis points, not 50. But if they come in another 20 basis points between now and, say, the 16th of September, then you could entertain a 50 rate cut. Now, it doesn't look like that's going to happen because keep in mind that the U.S. Treasury has put more emphasis on selling Treasury bills. They were 16% of the Treasury market. If you go back 4 years ago, today they're 20%. Janet Yellen made a deliberate decision to sell more T-bills. And T-bills auctions are really heavy these days. Very difficult to get them done. They're done, if you want to watch them, they're every Monday. They do the 3 and 6 month bills. And once or every 4 weeks, they do the year bill. But every Monday, they do the 3 and 6 month bills. They announce them on Thursdays. They settle or paid for on Thursdays. So the only exception to that was like this week, Monday was holiday. And so they did the auctions on Tuesday. But otherwise, they normally every Monday do the auctions. They do in the middle of the day. Sometimes that has an effect on the markets, depending on how those auctions go. But they're difficult auctions to do because of their size. Increasing debt means you have to find more buyers for that debt. So we'll see what happens. My guess is you're going to see 25 basis points because that's where the bills are, and that they're not going to move down enough to permit the Fed to lower them. But keep your eye. If you want a real prediction and not wait for the soothsayers, just watch the 1, 2, 3 month Treasury bills. Just watch them. You can see them on the CNBC app. Just on your iPhone, pull down the CNBC app, hit the third thing down at the bottom, and that'll show you the entire market.
Yesterday was the biggest day in corporate bond sales in U.S. history. What do you think that means?
That means they're not optimistic about lower rates coming higher. They think this is a good place to do it. The spreads are a little bit narrower than they might guess. The key thing about the corporate bond market is the difference between their yields and the yields on U.S. Treasuries of equivalent maturity. That's called the credit spread. When that widens out, that means people are getting scared. When that narrows, that means people are real comfortable, that people see corporations as almost as safe as treasuries. Sometimes that yield gets right on top of treasuries. I can remember back in the 70s, IBM corporate bonds traded almost right at treasury yields. It was amazing. But more commonly, there can be quite a distance. The wildest day in the bond market ever was in 1997 when they spread out 600 basis points in one day. That was because of the collapse in Southeast Asia and those currency markets. The following year, the Russian ruble collapsed, and there was a huge push-out in spreads. The yields on those things became very high. But if people are actively selling the corporate bond market, I wasn't really watching it yesterday, but if they're actively selling it, that means they think rates are probably going to be a bit higher down the road, which, given everything else, is a surprising view of the world because the economy seems to be weakening. The Fed seems to be winning the fight on inflation. Why would that spell higher rates? And the only culprit you can point to is the possibility that Treasury yields may not go lower. They may keep struggling with these auctions.
Clearly, the question of the day is the U.S. debt. U.S. debt is $35 trillion going to $50 trillion, 6 to 10 years. Federal receipts are roughly a little over $5 trillion. Interest rates go to 10%. We don't have any money to fund anything else. Is gold a good investment if you are correct that price levels will increase?
Well, gold it could work in the same sense Bitcoin could work. It's something other than a normal asset class. But there isn't any particular reason for gold to do well. And if you look back in history and see how does gold perform when you have recessions, inflationary periods, it's kind of randomly related to those things. If every time you've correctly predicted a recession, you bought gold, you wouldn't have fared very well. And the same thing is true of inflation. Now, we're in a period where gold is hotter than fire. It's been very strong in the last year or two. But the world is different today. You turn on television and there's some guy you recognize from some TV show and he's telling you about all his gold investments. So you have a whole industry designed to talk you into buying it. But that's not like buying a company. If you buy stock, there are people working at the company that have an incentive to make money. Their job depends on it. So stocks are far better investment than buying things like gold or Bitcoin or things like that.
If you were the dictator, what would you do? If you couldn't cut spending, which it looks like we're not going to cut spending, what would you do in order to solve the U.S. debt problem?
Well, the biggest problem is that we've tried to solve everybody's individual problems by shifting the burden of responsibility for health care, for old age, for really everything, education, whatever it happens to be, from the individual to the government. So the individual who 3 or 4 generations ago made some effort to provide for his future, for his old age, for his own health care, and really even for his education, no longer does that. Everybody looks to the government. So individuals are spending every nickel they can spend. They get out their iPhone and away they go, buy on Amazon, run their credit cards up. That's not the way people behaved 50 years ago. Savings rate has really dropped in this country because everyone assumes that government will solve all of their problems. And the only way you ultimately change that is to change that process. People have to take more responsibility for their own old age, more responsibility for their health care. Because if they don't do it, you don't have the resources. The government has to depend on people to have the resources. Where does government get its money? Except for the public. The public is busy consuming everything they can find in sight and has decided, hey, I don't need to take care of my health care. I've got Social Security coming, or I don't need to take care of my Medicare. I'm going to have Medicare for all, or whatever it happens to be. If no one in the society is saving, there are no resources to do any of these things. No matter what the institutions, we could be living in a communist country, we end up with the same result. Somebody has to put something aside. Otherwise, there's nothing left put aside to do it with. The government doesn't make things. They're not in the business of producing agricultural products or TV sets or anything else. So we have to shift the burden back to people for many of the things that now they take for granted that the government should do for them. Because the government doesn't, what's their source of income? Where do they get the bananas to put out there and give bananas to people? They've got to get them from somewhere, and they have to get them from the private sector. And if the private sector isn't saving and is just spending every nickel they have, it's not going to be there. That's, in essence, what's happening.
So modern monetary theory says you can print money without any negative effect on price levels. What do you think?
Oh, I love that theory. I don't see why anybody has to work if that's true. All we have to do is find a printing press, and away we go. That's kind of ridiculous. Anything you increase a lot in supply is going to lose its value. I mean, I don't care what it is. It doesn't matter. Money is no different than apples or oranges or peanuts or grapefruits or cars. If you increase the supply compared to everything else a lot, it becomes cheap. That's just simple economics. So if you print a lot of money like we did in 2020 and 21, we increased the money supply 50% over a period of 16 months while output was constrained. So what happens when you increase one thing 50% and everything else is just constrained? You get a fall in value, and that's exactly what happened. Perfectly predictable that we had inflation.
If many economists are correct and modern monetary theory allows you to print money, why don't we abandon the tax code and just print money and say we can get rid of the IRS? What's your counter to that argument?
Well, I would say that folks that are adherents of modern monetary theory tend to be on the fringes of the economics profession. I think more concerning are those who are right at the pinnacle of the profession, and I would include there Janet Yellen and folks like that, and all the advisors to the Fed and all the academics who've been writing papers in the so-called neo-Keynesian Phillips curve literature. That's the latest state of the art in academic research on this. And these people think that whatever inflation is caused by, it can't possibly have anything to do with the money supply. That is the view of the folks that win Nobel Prizes in economics and get promoted and have all the big chairs at Harvard and Yale and MIT and everywhere. And when I was in Melbourne, Australia last year, I chaired the money and banking session at the International Economics Association. And there were several of these folks, high-powered macro guys in the crowd, and I asked them point blank, I said, is it your view that changes in the money supply don't affect the price level? And they said, yes. And I said, well, if that's the case, why do we tax people? Why can't we just print $6 trillion like we just did? We printed $7.5 trillion in 20 and 21. Why don't we just do that every year and get rid of the tax code? And there was an amazing silence. I didn't get an answer. So I asked again, the same kind of question. I said, can't we just really make our society rich by just doubling the money supply every day and buying everything we want? And can't people just not go to work anymore? This sounds great. If we can buy all this stuff with printed money and it's not inflationary, then what's the downside? There's no downside. And by that time, they were all giving me dirty looks. So they believe that money has no relevance to inflation. What do you do with the supply of money? They believe that, and it's in their papers. And most papers on inflation, the money supply is not even in the paper at all. It's not even there. Go back and look at Powell's speeches. At Jackson Hole, Powell gives a speech every year. He just did a couple weeks ago. And in the speech, he also has a 20-page appendix, typically 20, 25-page appendix full of economic data. No monetary data. The one thing that has nothing to do with inflation is the printing press that the Fed uses. That's very convenient for him, but it raises the question, if that's right, if the money supply doesn't matter, then the question you raised comes up. Why don't we just print money and pay all our bills, and why bother the inconvenience of April 15th? I think most Americans would love to get rid of April 15th and collecting taxes and paying them. It's merely $6 trillion, and after all, we printed $7.5 trillion in 20 and 21, and they all said it was not inflationary, so why can't we just do $6 trillion every year? It's not inflationary. This is great. Well, you can see the absurdity of the argument. It's ridiculous. And when you press them, it's interesting. At the most recent Jackson Hole, they've decided inflation is caused by, of all things, quirks in the labor market. They take a so-called ratio of vacancies and then divide that by the unemployed. So vacancies over the unemployed. So if that ratio goes up, they say it predicts inflation. If that ratio goes down, it argues inflation's going to ease. That is the most absurd argument, but that was the key paper presented at Jackson Hole. Why didn't they just pick the peanut market or some other market? Why? It's crazy. If they want to know why the price of money is falling, how about looking at supply and demand for money? But economists won't do that. So this paper is celebrated. It's by one of the researchers is from CERN and the other's from Brown University. Go online. Just Google Jackson Hole, August 2024. You'll find the symposium in the paper. Read it. It's, I guess, in my way of thinking, it's borderline ridiculous, but it has captured the fancy of CNBC's devoted an hour to it this morning on their discussion about inflation. Well, why don't we pick some other market? How about the market for Skittles? What's the supply and demand look like in that market? Maybe that's affecting the price of cars. That's the kind of nonsense this is. If you want to know what's determining the price of steel, I suggest you look at the supply and demand for steel in the country. That might be the best way an economist ought to think about it. But strangely enough, when it comes to inflation, that's not the way they think about it. They have all these crazy views. So in 2020, when they increased the money supply and over a period of the next 12 months by 50%, $7.5 trillion, took it from $14.5 trillion to $22 trillion, all the predictions were no inflation. And even as late as August of 2021, after inflation had already soared above 5%, at Jackson Hole, Powell said the same thing. Oh, this is not a big deal, no inflation, blah, 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 blah. It wasn't until March of 2022 that they took any action. They were still increasing the money supply in February of 2022. They were in the marketplace printing more money and buying more government securities. They did nothing until middle of March 2022 because they so believed that you could double the money supply every 15 minutes and it would not matter. That's really what Powell believes, and I think he still believes it.
And what's the U.S. government doing with the money supply now?
The money supply is growing gradually. It has been ever since 2023, about March to April, somewhere in the spring of 2023. They essentially stopped cutting the money supply and started increasing it very gradually. It was up about a little over 1% until the spring of 2024. I haven't seen the latest numbers, but I'm sure that's what it's going. But here's the fear. The fear is they go into an auction and they have trouble. And that happened one time in 2019 or 20. I've forgotten the exact year, but it's if you go to Jackson Hole Symposium of 2 years ago, you'll see a study of it. They intervened in the marketplace, bought $1 trillion worth of government securities to save that auction. Well, what happens if they have to do that? Now, all of a sudden, all the numbers start changing. $1 trillion would be a 7% increase in one day in the money supply. Try increasing the number of cars in the world by 7% in one day and find out what happens to the price of cars. So there's always the chance that the central bank, since it has the ability to issue money at will by pressing a digital switch, that to save the auctions, they'll come in and print money. That's pretty much what they were doing in 20 and 21 without admitting it. And I think that's the great fear ahead, that they will see inflation as not an issue and that the role of the Federal Reserve is to stabilize these auctions. They didn't think it would be inflationary when they did it in 20 and 21, and they do not think so today. They still believe the same mindset. If they wandered into the market and increased the money supply by 100% over the next 2 years, there's not a single economist working for the Fed or even talking to the Fed that believes that would be inflationary. So it's not the modern monetary theory, folks. Those folks are kind of on the fringe. It's really the guys and girls in the driver's seat that are driving the policy and ignoring the money supply. I guess next time somebody writes a paper on what determines the price of peanuts, they'll go take a look at the market for horses and try to figure out from market for horses what's going on in peanuts. All the modern macro people look at the labor market to determine the rate of inflation. That's all they look at. That's all Powell talks about is the labor market. Labor market doesn't have anything to do with inflation. Inflation, as Milton Friedman once said, is always a monetary phenomenon. If you just look at the data, go out and plot the money supply divided by money GDP. Take that variable, money supply divided by money GDP. Plot that and plot the price level, and you will see what happened in 2020-21. You see a jump in that, and then after that, you see inflation.
Is there a time lag?
Yeah, there's a brief time lag, 3-4 months. But that's what you would predict. It's not going to happen overnight. But it happened. And it happened in every developed country in the world. It happened in Japan, Canada, Sweden, Switzerland, happened in the Eurozone. The data shows that it was perfectly predictable that inflation would take place in every one of those countries if you thought it was caused by a jump in the money supply. Because the jump occurred in most of these countries in early 2020. And it was after that that every single one of those countries had inflation. That can't be an accident. If it was caused by all these other random sources, you would see that in other countries. Japan wouldn't necessarily have had the same experience we did. Different countries depend on supply chains in different ways. Some countries don't import a whole lot. Some import a lot. Some are on the other side of the supply chain, and some are in different positions regarding oil. Some have a lot of oil, so if oil prices jump, that's really kind of good for them. Some don't, and they're importing it. They're treating the U.S. as if somehow that we're peculiar, that we look only at the labor market. Some economies in the world had the economy in a slump. Europe's been in a slump for a decade. Why did they have so much inflation? Europe hasn't grown. When is the last time Germany grew as a country in GDP? Or France or England or any of these countries? The U.S. is the strongest growing country in the world among developed countries and has been. So this idea that somehow all you have to do is consult the labor market and you're going to be able to predict inflation it's just, I hate to use the word ridiculous describing an established academic point of view, but it's ridiculous.
So Professor, we're 35 trillion plus in debt, the U.S. debt. It's hard for me to conceive how much money that is. How do you talk to your students, and how do they conceive the idea of 35 trillion in debt going to 50 trillion? How do we bring that down to a level that we can all understand?
It's difficult to understand because it's government debt, and we don't much understand government. We don't know what a government is. Half the population tends to think it's a beneficial angel out there waiting to save them from themselves. And the other half tend to think it's some evil incarnate devil out there out to get them. So we don't really understand the government, so it's hard to understand government debt. But we do see many examples of what happens when you run too much debt. We saw it in the Weimar Republic in the 1920s. We've seen it in Latin American countries over and over again. We saw it not long ago in Greece. But Greece got bailed out, much like Detroit got bailed out in America. So some of these places have been bailed out, but you can't bail out the whole Eurozone, and you can't bail out the whole U.S. If debt gets too high, then what happens is, what we're beginning to see, the government begins to print money to pay its expenses and the interest on the debt. And what happens is you get inflation, interest rates go up. They don't go up because the central bank's doing something. Interest rates chase inflation. If inflation goes to 9%, like it did here in the U.S. just 3 years ago, interest rates will go up. You're not going to have zero interest rates and 9% inflation. People aren't going to loan money for the opportunity to lose 8% in real terms. So interest rates follow inflation. That's just the way it is, with or without a central bank. There's kind of a myth that the central bank's required to do that. Again, to harken back to Melbourne, I was in a panel discussion with two heads of central banks, the head of the Australian central bank and the head of the New Zealand one. And I asked them, what do you think would have happened if, when Jerome Powell decided to start raising rates, if he had just stepped aside, said, I'm not going to do anything. I'm just going to, go on vacation for 3 or 4 years, and we'll let the interest rates do what they want. And the reason I ask that question is these guys are economists. They know if inflation goes up, interest rates will go up with it. That happens every time inflation goes up, and whether you have a central bank or not. The U.S. didn't even have a central bank for almost 100 years. And then we passed the Federal Reserve Act in 1913, and that brought a central bank to the U.S. But before that, every state had its own banking system in America and did whatever they wanted, and interest rates tracked inflation. When inflation would go up in some small community, interest rates would go with it, because the interest that you receive as a lender depends on inflation. The real interest, if inflation is 10%, you're not going to loan money at 2% for sure, because everything you buy is going to cost 10% more. So interest rates just follow inflation, and ultimately, if you use the money supply to solve your national debt issue, if you decide, well, we're going to print money to get over this huge debt and these huge interest payments, it'll be inflationary, interest rates will spiral out of control, and after a while, you're the Weimar Republic. Your population's got wheelbarrows wandering around hauling worthless currency everywhere. So that's where it goes, Hunter.
The U.S. government has $35 trillion in debt. I wonder, it'd be interesting to ask the average U.S. citizen how many billions are in a trillion. I wonder how many would know 1,000 billion in a trillion.
Well, that's interesting. A question very similar to that. Somebody was on the Harvard campus and asking them a bunch of trivia questions, see if they knew as much as the average fifth grader. And one of the questions was, how many grams in 1,000 kilograms? Well, the answer, of course, is 1,000 times 1,000, which is 1,000,000. But there were all these Harvard kids that seemed to be stumped by that question. Maybe we should substitute the Harvard freshman class with a bunch of fifth graders. That might work out better. So people don't know as much about the things that they should. And, that's a fixable problem. If you tell me, Hunter, that you don't know calculus, for example, and suppose you don't, and I could just say, hey, Hunter, you got a TV? Yeah, YouTube's free. You can pull that app down on your TV and then just search in there for elementary calculus courses. And then you can choose between half a dozen of the best teachers in the world. And you can learn everything you want to learn. You can't. So if you're out pounding the wall saying, hey, I know I was never taught this or that or the other, guess what? You can now be taught any subject you want to learn free of charge just by going to YouTube. And they're really good. I don't know if you've looked at those things, but...
Well, I've taken Michael Sandel teaches a fascinating ethics class at Harvard.
They're great courses, and I have my grandkids. During the pandemic, I had 3 little boys at my house, and of course, I was the instructor. All their schools had been closed. So the regime was they had to take math tests every morning, but when we came to a new subject, I would teach it partly myself, but then I would go to YouTube and get one of these people who really know how to teach it, or some of the animated classes. So anything you don't know, the beauty is you can learn it. And this is no different. If people want to know about the national debt, just put national debt in YouTube, and you'll have a host of lectures about what the national debt is, how it works. Or you could just go to the U.S. Treasury website. All the details are there. The U.S. Treasury website will tell you minute to minute what's going on and how much of it is T-bills and how much of it is Treasury notes. The world's different today. 4 decades ago, you couldn't find any of this out. There were no free lectures anywhere. But now, education basically costs zero if you really want to learn something.
Unfortunately, the U.S. is 35,000 billion in debt. 35,000 billion in debt, heading to 50,000 billion in debt. No end in sight, Professor. We need to talk about this every week.
Well, the direct answer is you might have to cut something off, but that politically is very hard to do. You might have to tell folks that they're not going to end up getting... You're going to be forced to do that anyway to some extent. For example, the healthcare promises that we're making to old people cannot be fulfilled. They're not being fulfilled in Europe. All sorts of major medical emergencies for older people are now just thrown on the ash heap. They're not doing them. You're just added to a long list of people awaiting surgery, and you typically die before that date comes. That will come to America because we don't have the resources to do all this, and particularly when people don't take proper care of themselves. If you walk down the street and look around and see how many people are obese and problems like that, many more than were 4 decades ago or 5 decades ago, Americans don't go out of their way to take care of themselves. You see a few people running and doing this, but they're the exceptions. Most people, if they thought they had to pay for their own health care, they might take a little time to make that health care better on their own. But if they think somebody else is going to pick up the tab, why bother? Why not just do whatever you want?
Thank you, Professor. We'll talk again next week. Look forward to seeing you.
Thank you, Hunter. It's always a pleasure.
Thank you for joining us for the Rubber Meets the Road Economics podcast. If you enjoyed the discussion, remember to subscribe and stay updated with future episodes. Join us soon for more conversations about modern economics on the Rubber Meets the Road Economics podcast.